So we're doing a tutorial, the review for chapter 15, 17, 18, 19, and 20. So we're at the end of the semester. So all the questions I'm doing tonight are past final questions. So you might see some things that are similar in your final. They kind of always do the same type of questions for chapter 15 and 17 for the equity section. And also for pensions, it's quite similar. So if you're good doing these questions, you should be good also in your final. For chapter 18 and 20, they're a little bit more tricky. They're the harder chapter in the final. So do spend a little bit more time on them and do more practice problems until you understand the concepts. So I'll jump in with the first question, which is on chapter 15 and 17. So M Funds Limited, which is IFRS compliant, reported the following balances as December 31st, 2014. So you have the amount for the convertible bonds, call options, cumulative preferred shares, common shares, the contributed surplus on repurchase of common shares, and return earnings. The company also informed you details related to the following transaction during 2015. On February 1st, 2015, the company declared and distributed a 20% stock dividend for its common shareholders. The shares were being traded in the market at $30 after the dividend. On March 1st, 2015, it acquired 18,000 of its own common shares in the market at $30 per share and retired them on the same day. On April 1st, 2015, the company issued 17,500 common shares in exchange for plant and equipment assets at $336,000. On May 1st, 2015, 40% of the stock option holders exercised their options when the market price of the common share was $31. On May 15, 2015, the company declared a 3-for-1 stock split on common shares. The common shares were being traded at the adjusted market price of $32 per share and after the stock dividend distribution. On August 1st, 2015, the company issued share certificates for 3,708 common shares to subscribers who had applied to an earlier share subscription issue. These subscribers had paid for the shares they had subscribed at $34 per share. On October 1st, 2015, 20% of the bondholders submitted their bonds to the company for conversion into common shares. Dividends were last declared in 2012. Dividends for the current year were also not declared. And then they give you additional information. The cumulative preferred shares had been issued several years ago when the company was incorporated. It carried a dividend rate of $2.10 per share. And as of January 1st, 2015, one preferred share could be converted into 2 common shares. The company reported earnings from operations of $1.8 million. For 2015, there were no discontinued items to report in 2015. The bonds had been issued at par in 2012. No premium was charged for the conversion rights, and that was credited for the full amount received. Each $100 bond was convertible into 8 common shares. So, required 1, prepare the journal entries to record the transactions effect of items A, B, C, E, and F. So we're going to start with required 1 and transaction A. For A, it said that the company declared and distributed a 20% stock dividend for its common shareholders, and the shares were being traded in the market at $30 after the dividend. So your debit account is common shares distributable to common shares. The amount is going to be, they're issuing 20% of 112,500, and they were being traded at $30. So you're going to do 20% of 112,500 times 20% times $30. So that is 675,000. And then, not here. And the amount of shares that were issued is 112 times 20%. I'm just calculating this because we're going to need it in the future question. So it's just going to be easier. And then for D, on March 1st, it acquired 18,000 of its own common shares in the market at $30 per share and retired them on the same day. So when there's a reacquisition, you have to first attribute the amount to the share capital account, which in this case is common shares, to the same price as when issued. So basically, you're reducing your common share account by the amount of shares that you're buying back. And then if you have any excess after that, between your amount that you're paying versus what you're retiring from your book, you're going to apply it to your contributed surplus repurchase of common shares. If there's an account, you might not have an account. And if that's the case, then you go to contributed surplus and options, warrants, any other contributed surplus you might see. And you also go to the third if you have any excess, if after applying your the balance of your contributed surplus repurchase of common shares. And then at the end, if you still have a balance, then you apply it to your retained earnings account. So for this transaction, the common shares amount, you're going to have to basically we have the number of shares, so we know that we're buying back 18,000 shares, but at what price? What's the book value of our shares? So we're going to have to look at first what's our balance at the beginning of the year, so this line here, and we're also going to have to apply the effects of our transaction A onto our balance. Then we're going to have our total book value of our common shares on March 1st. And we're going to be able to divide that by the number of shares that we have, and we're going to have our price per unit. And with that price, we're going to be able to do the rest of the transaction. So the book value cash of our common shares is $2,880,000 plus the amount here that we added for the stock dividends. And then the number of shares that we have is 112,500 plus 20% of that amount. So plus the 22,500 that we issued for the stock dividends. So our price per share, oh my God, is $26.33. So here, the amount that we're going to debit from our common share account is going to be $26.33 times the 18,000 shares that we're repurchasing. So now I'm going to put down first my cash amount, just so we know how much of a difference we have between the two. So we can apply it to contributed surplus or retained earnings. So we're buying back 18,000 shares. And the market price of those shares are $30 per share. So we have a difference between the two of 66,000. So now I'm going to look, I did this part. I'm going to look at two. If we have an account that's contributed surplus repurchase of common shares. And look at this, we do. We have 31,200. So I'm going to put that down here. And basically credit the whole amount, debit the whole amount, so it's net zero. Can only purchase shares. And then I'm still gonna have a balance here. So I'm gonna go look in my accounts. I have a contributed surplus on options, warrants, or anything else, and we don't. So I jump to the fourth, and it's a debit to our retained earnings. The difference. So the amount is going to be 34,800. For C, on April 1st, the company issued 17,500 common shares in exchange for plant and equipment assessed at 336,000. So when you're issuing share in exchange of a good or a service or an asset, in this case, under IFRS, the value that you're going to use is the fair value of the goods exchange, unless they are not reliable. So what I mean by that is, if it's not really the fair market value of the good. So for example, if it's said in the sentence that the management assessed the equipment at 336,000, then this is not reliable. And instead, we would have used the fair market value of the shares. Under ASCII, you use the most reliable between the fair value of the good or the fair value of the shares. So in this case, it doesn't really mention anything about it being non-reliable, so I'm assuming that it is the correct fair market value. So you're gaining property, plant, and equipment at 336,000 in exchange for common shares, the same amount. For D, they didn't ask to do the transaction because it is an exercise of stock option holders. So you don't have to do the transaction because you saw that pre-midterm, and we don't have all the information necessary to do the entry. So we're just going to skip it, and I'm going to go to E. On May 15, the company declared a 3-for-1 stock split on common shares. The common shares were being traded at the adjusted market price of $32 per share after the stock dividend distribution. So here it's a little trick, because when you have stock splits or reverse stock splits, you don't have any journal entries to record, because the dollar value of your common shares doesn't change. It's just the number of shares that becomes higher, but no impacts on the dollar amount. So in this case, the quantity of shares tripled on May 15, but the total value stayed the same. So no journal entries required. You can still calculate the impact of the number of shares, but we're going to do that later. And then I think that's it for A. Oh, and F. For F, on August 1st, 2015, the company issued share certificates for 3,708 common shares to subscribers who had applied to an earlier share subscription issue. These subscribers had paid for the shares they had subscribed at $34 per share. So that is going to be a debit to the common shares subscribed account. And then you're issuing your common shares. And the value is going to be your 3,708 times the amount that they subscribed for, so $34 per share. And now it's done for requirement 1. For requirement 2, they're going to ask us to determine the weighted average number of shares for the basic earnings per share for 2015. So I'm going to do my little table. So I'm going to put down the date, the number of shares, the time, the split / dividends effect, and the weighted average common shares. So we always start with our beginning balance, which is going to be on January 1st, 2015. How many shares did we have? And we had 112,500 shares. I'm going to check the time later on in the other columns also. And then I just look at the transaction that occurred, and whenever there's an impact on the shares number, I'm going to put it down in this table. On February 1st, what happened? They distributed a 20% stock dividend. So their number of shares increased by 20%. So I'm going to do 1.2 times my balance on January 1st. Okay. And then on March 1st, they reacquired 18,000 of their own common shares. So their total number of shares on the market decreased by 18,000. I'm going to take my balance on February 1st minus 18,000. Before that, with the stock dividend, because it increased by 20%, but there was no new common shareholders coming in, right? So every common shareholders on February 1st, 2015 just had an increase of 20% on their shares. So they still have the same power in the company, the same percentage of ownership in the company. So for comparability reasons, so when they're looking at basic EPS from last year versus this year, they want to make sure that last year's basic EPS reflect the stock dividend of this year. Because if it doesn't, then they're going to be like, what happened? Because this year, the basic EPS is going to be a lot lower because there's more shares, because it increased by 20%, even if there's no new shareholders. And last year, it stayed the same amount, so the 100% instead of 120%. Even if like it's the same net income for both years, since the amount of shares that change, your basic EPS for last year is going to be a lot higher than the one for this year because it didn't take into consideration the stock dividend. So to make sure that last year's basic EPS is good and rightfully you're able to compare both amounts together, you're gonna time any preceding amount of shares, so from this year and also from previous years, by 1.2 to reflect the stock dividend that occurred. You do the same thing when there is a stock split and when there's a reverse stock split, because the same thing happened where only the amount of shares increase or decrease if it's the reverse stock split, but the percentage of ownership of each shareholder didn't change. So you want to reflect the increase of shares for every shareholders into your weighted average common share calculation. So for February 1st, you want to make sure that your balance on January 1st is reflected of your 20% stock dividend. So going back to March 1st, they reacquired 18,000 of their own common shares. That decreased by 18,000. And then on April 1st, 2015, issued 17,500. So that increased the number of shares. On May 1st, on May 1st, 40% of the stock option holders exercised their options when the market price of the common shares was $31. So when they're talking about the stock option holders, they're talking here about the 3,000 call options. So 40% of the 3,000 call options. And then they were entitled to 1 common shares. And then we're also going to time it by 1.2 to reflect the stock dividend that happened on February 1st. I'm doing that because the 3,000 call options, they kind of went into activity, like they were reflected on their before the stock dividend occurred. So basically here on December 31st, you already had the call options. So now they're not gaining 1 common shares when they're going to exercise their rights. They're going to gain 1.2 common shares because the value of the common shares changed. Oops. And then plus your balance on April 1st. Yeah. All right. And then on May 15, the company declared a 3-for-1 stock split on common shares. So the balance of your shares tripled, and you're going to want to reflect that on every balances of shares from before May 15. So I'm going to put here 3, 3, 3, 3, and on January 1st, you're going to do 1.2 times 3. On August 1st, the company issued share certificates of 3,708, so that's going to increase your balance. And then on October 1st, 20% of the bondholders submitted their bonds to the company for conversion into common shares. And then they didn't put here how many, like if they converted, how many common shares can be converted to. So here it says that each $100 bond was convertible into 8 common shares. So what we're going to do to calculate it, we're going to first calculate how many bondholders there are. So 250,000 divided by 100, and then times 20%, and then times 8 shares, and then times 1.2 and 3. So I'm doing the same thing here as I did for the 40% of the stock option holder. So I'm reflecting the stock split and the stock dividend that occurred beforehand. And same reasoning is because beforehand I already had the convertible bonds that were issued. Plus this here. All right, so now all the transactions are put into the little table, so I'm going to check the time. So for this amount, it only stays for 1 month at this number. Same thing here. Same thing here. Same thing here. On May 1st, it stayed half a month. So I'm going to do 0.5 divided by 12. May 15, it stayed 2.5 months, June, July, and then half of May. August, it stayed August, September, so 2 months. And then October is going to be 3 months. So I'm just going to sum everything just to make sure that it equals to 1. It should. All right. And then for the weighted average common shares, I'm going to do the number of shares times the amount of time that they stayed at that number times our split div column. And same thing here. And then I'm going to add everything up to find my weighted average common shares for the year. So it's going to be 407,400. Here. All right, so B is done. And then for 3, determine the basic earnings per share for 2015. So to find that, we're going to need the net income. We're going to need the dividends for the preferred shares. Even if the preferred shares are cumulative, even if they didn't pay a dividend for that year, we're still going to remove that amount from our net income because the preferred shareholders are still entitled to that money. So when they're going to declare a dividend in future years, they're going to pay the dividend for 2015 first before they pay any dividend to any common shareholders. So we want to remove it because the common shareholders don't care. They're never going to have access to that money. And then that gives us my net income for the common shareholders, and we divide it by the weighted average common shares. Should say somewhere the net income for the year, probably here. Yeah. So the net income from operation is 1,847,790. Then my dividends for preferred shares, I'm going to check if they're cumulative. Yeah. they're cumulative. So I'm going to calculate the dividend, which is $2.10 per share. So 2.1 times 36,000. And then to find my net income for common shareholders, I do my net income minus my dividends. And then I divide that by my weighted average common shares that we found in B. And that gives me a basic EPS of 4.35. And we're done with section A, the first requirement. This question is really long. I don't know how they did that on the final by hand because it's like super long, but yeah. All right, so section B. You must still continue to use all the basic information contained above, except where stated otherwise. Now assume for this section only the following. Assume that none of the convertible bonds nor the convertible preferred shares were converted during 2015. Similarly, none of the call options were exercised during the year. The exercise price for the call options, duly adjusted for dividends and splits, was $9 per share. Further, assume that on January 1st, 2015, the company had also issued 3,300 put options to its directors as compensation for their services during 2014. Each option enabled the holder to sell one common share to the company at an exercise price of $12, which is also similarly adjusted for dividends and split. All options were still outstanding on December 31st, 2015. There's a tax rate of 20% and average market price of $10 for the company's common shares during 2015. And regardless of your computation in section A above, assume that the weighted average number of shares for basic EPS was 407,400, which we got right, so that's great. All right, so first requirement is identify the potentially dilutive securities, which could be included in the computation of your diluted earnings per share. Be sure to provide supportive computation with your answers and rank these securities where required. So there's three types of dilutive securities. You have your convertible bonds, your convertible preferred shares, and your call options, warrants, put options. There's a specific name for that, but it's escaping my mind. So why these are dilutive is that they all could potentially affect the basic EPS if they were exercised right now. So the common shareholders want to know if at a random point in the year, in next year, the convertible bonds are going to get all exercised. Well, that's going to come and have an effect on my basic EPS because there's going to be more common shareholders. So I want to know, like, what's the worst that my earnings per share could get? So what's the lowest that it could get? Because all these three dilutive securities could impact the basic EPS. That's why they're called dilutive. So there's the convertible bonds, call options, put options, and warrants, and convertible preferred share. And lucky us, we have all of these in the problem. So what I want to find first, I'm going to do first the call option. And I'm going to find the net income effect. I'm going to find the share effect, the incremental EPS, and at the end, I'm going to rank them. So the net income effect is if the call options were exercised, what would be the effect on my net income? Same thing with the share effect. If the call options were exercised, what would be the share effect on the total common shares? And then the incremental EPS is your net income effect divided by your share effect. Your rank, you're finding it at the end when you found the incremental EPS for all your potentially dilutive securities. So for call options, what you want to look for is, well, with call options, there is an exercise price, and there's also the average market price. And these will differ because that's the whole thing of the call options is you want to have a lower price and on the market, so that your customers, no, that your potential shareholders are gonna buy your shares at an advantageous price for them. So what you want to look at is how many more shares can they buy with their call price versus if they just bought it with the market price. So first we want to find the total, the amount, total amount that they can buy. So you're going to do the number of common shares that your call option holders can buy times the exercise price on those call options. Then you divide that amount by the market price, and you get the number of shares that you can buy on the market with the same amount of money. And the difference between the amount of shares that your call option holders can buy versus what they could have bought on the market is going to be your share effect. For call options and put options and warrants, there's never an income effect because it doesn't affect your income. So first, how many shares can they buy? You do 3,000. You're going to do 3,000 shares, but you still have to take into consideration your 1.2 and your 3 from your stock dividend and call option, put options, and warrants. There's like the name that we saw in chapter 16, but I don't remember how all of these are called, but it's these 3. And they're all calculated the same way. So yeah, for the number of shares that they can buy, you have to still take into consideration your stock dividend and your 3-for-1 stock split, because they were the call options were put on the market before the stock dividend and the 3-for-1 split. And then what you're going to do is you're going to find the dollar value if they wanted to exercise all their call options. So that would be $10,800 shares times the exercise price of $9 per share. So the call options were on the market. They issued them on the market before the 20% stock dividend and before the 3-for-1 stock split that happened during the year. So because of that, the 3,000 call options that are that you can buy 1 common shares with them, you have to put the effect of the 3% and of the times 3 into your calculation for the number of shares that they can buy.
Sorry, you have to take it into account or you don't?
You have to.
But even if it's, if it's before those, you have to take it into account?
Yeah, exactly. Because now when they put them on the market, well, the 3,000 call options were equal to 1 common shares. Now your 1 common share at the end of the year is not equal to 1 common shares. It's equal to 1 common shares times your 1.2 because of the 20% stock dividends. And then after that, what they did is they triple the number of common shares that they had. So your 1 common share is now equal to 3.6 common shares. But
and if it was, sorry.
Yeah.
If it was issued afterwards, after the stock splits and stock dividends, then we don't have to take the factors into account. Is that it?
Yeah, exactly. So
Okay.
if it was after, it would have been just 3,000.
Okay, perfect. Thank you.
No problem. All right, so the dollar value is 97,200. And then you're going to look at how many shares can they buy with the market price. So it's going to be the 97,200 divided by the average market price, which is $10. So if they bought the shares on the market, they could have bought 9,720. But because they have the call options, they can now buy 10,800. So it's more, and it's an increase of 1,080 shares. So that's going to be your share effect, is that if the call options are exercised, then you're going to have 10,080 more shares in your weighted average common shares calculation than if they just bought it regularly on the market. Your incremental EPS is 0, which is normal. And after that, I'm gonna do the put options. Similar logic in the calculation, it's just that now, hold on, they sell it at a higher price than the market price. So how many more shares can they sell than if they just sold it on the market? Your income effect is still 0. So how many shares can they sell? Here, so see here, they issued on January 1st, 2015, the 3,300. So I'm still going to take into consideration the 1.2 and the 3 effects. So the number of shares that they can sell is 3,300 times 1.2 times, and that's the value of, what's the strike price? Value of $12 per share. And then how many shares did they have sold if they use the market price? Well, then this amount divided by 10. How many shares can they sell? Yeah. My numbers are right, but I think my explanation wasn't. But basically, you find the difference between the two amount of shares, and that difference is your share effect. So your share effect is 2,376.
Sorry, just a question. It was 142,560 divided by 10.
Divided by 10, yeah.
Why 10?
Because
Okay.
it's the average market price for the year.
Okay, so we don't look at the exercise price?
We look at the exercise price, see how many shares they can sell. But we looked at it when we calculated the total dollar value that they could gain by selling it them. Because here we did the how many shares they can sell times 12, the exercise price.
Okay. And then
yeah.
Sorry, and then the 2376 is the difference between
how many shares they can sell using the exercise price.
Okay, and then the market price.
Exactly, yeah.
Okay.
Yeah, it's the same thing that you did for the call options.
Call option, okay.
And the incremental EPS is again 0. Then I'm gonna look at the convertible bonds. So the convertible bond, the income effect is basically the interest expense after tax that's been avoided. So if they convert their bonds, they don't have to pay interest. So interest expense after tax effect avoided. And the number of shares is the number of shares that is going to be issued if they convert all the bonds. So your net income effect is going to be 1 minus the tax rate, which is 20%, times your book value of the convertible bonds, so 250,000, times your interest rate, which is 7%. Your share effect is going to be your number of bonds, so 250,000 divided by 100, times they're all convertible into 8 common shares. And then you have to take into account your 1.2 and your 3. And then I'm missing something. Times 10. Oh, am I missing a 0 somewhere? Okay, 1.2. 3. Oh, I put 0.3. It's supposed to be 3. 72,000. So your incremental EPS is going to be 0.19 cents. And then your preferred shares, your income effect is the dividend, the preferred shares dividend avoided. And your shares is the number of shares issued. So your dividends, so how much dividends are you paying right now for your preferred shares is 36,000 times $2.10 per share. And then the number of shares that are going to be issued is going to be 36,000. One preferred share could be converted into 2 common shares, so it's going to be 36,000 times 2. No. Oh, and then times 1.2 times 3. That's the first thing, actually, like the 1.2 and 3, that's the first problem that I saw that I took into consideration. That's one of the main reasons why I put in the final review, because in your book, they don't really cover that. So at least you'll know for your final if they throw it in. So your incremental EPS is going to be your income effect divided by the share effect. So it is 1.2917. So we've done all our dilutive, potential dilutive securities, and then we're going to rank them. So how we rank them? We rank them from the smallest to the biggest. And if, for example, the incremental EPS is bigger than your basic EPS, it's an anti-dilutive security. And what does that mean is that instead of decreasing your EPS, it's going to increase it. So it's good for your common shareholders. So we're not going to take it into consideration in our dilutive security. So if that happens, you just don't put it in the rank. You just kind of put it aside. For the ranks, these two are at 0. So they're both going to be rank 1. And they're going to be the first that we use to calculate our diluted EPS. After that, the smallest between the two is the convertible bond. And lastly, it's our preferred shares. So now I can finally calculate my diluted EPS. And how I'm going to do that, I'm going to put here my earnings, well, my net income, my share, and then EPS. I'm going to start with my basic EPS. My net income that we used was this one here. So without the dividends for preferred shares, and the number of shares was our weighted average common shares, and gave us an EPS of 4.35. Right, so then I'm going to add my rank 1 dilutive security. So I'm going to add my call option. I'm going to add my put option. So the call option, there was no net income effect, but the number of shares was 1,080. And same thing for the put option, no income effect, but my share effect was 2,376. So then I'm going to calculate my rank 1 EPS, which is going to be the sum of the net income and then sum of the shares. And the EPS is the 1,772,000 divided by 410,000. So 4.31. So when you're calculating them, be on the lookout to make sure that every time you're calculating a rank, it's still lower than your previous rank. Do you mind repeating how you got the income effect of the bonds? Yeah, sure. So The income effect is the interest expense that's been avoided after tax, because your net income is after tax. So first what I did is I the amount net of tax, so 1 minus your tax rate of 20%. Then I did the book value of my bonds times the interest rate. Because when you're calculating the interest expense for convertible bonds, you're doing your book value times your tax rate, times your interest rate. All right, so I'm gonna move on to my rank 2, which was the convertible bonds. So my income effect was 14,000. My share effect is 72,000. And then I'm gonna be calculating my rank 2 EPS, which is gonna be the sum of my rank 1 and convertible bonds. And then here, same thing. That gives me an EPS of 3.70. So it's still lower than my rank 1, so it's still dilutive, so we keep going. And then for rank 3 is my preferred shares, net income, and then share effect. And then my rank 3 EPS is going to be these two together and these two together, and that gives me a diluted EPS of 2.51. And since this amount is lower than my rank 2, this is going to be my diluted EPS. If, for example, instead of being 2.51, it was 4, then my diluted EPS would have been 3.7, because the 4 becomes anti-dilutive. So that means that it increases my diluted EPS. But it's not the case. All right, so we're done section B. We have section C. Long question. Now assume for this section only that there were no transactions affecting share equity during 2015. Thus, on December 31st, 2015, the company reported the following. So then they give us the cumulative preferred shares, the common shares, and the retained earnings. Further, the company also reported earnings from operation of $1,847,000 for 2015. The cumulative preferred shares, as stated above, could participate in dividends declared after the common shares received the minimum dividend of $3 per share. Participation in the excess dividend is based on the relative total capital contributed by each group. The company management wishes to declare dividends for 2015 such that each common share would be entitled to a dividend of $4 per share. Dividends were last declared in 2012. So they're going to ask us to do the total amount of dividends which the management would declare. So we don't know how much dividends that they're declaring. We're going to have to find that. And the total amounts payable to each group of shareholders. So how I'm going to set it up is I'm going to basically redo this, but in Excel, so it's easier for my calculation. So I have my preferred shares, my common shares, the number of shares, and the total dollar. Number of preferred shares is 36,000. Number of common shares is 112. Oh, you got income for preferred shares. Yeah, sure. So it's the preferred share dividend that's been avoided. So basically what you're calculating is your preferred share dividend. So it is the number of preferred shares times the number times the dividend per share. So they are all the shares get a $2.10 dividend. So no, you don't need it, because when you're paying dividends, it's after you calculated your net income. No problem. So you only need the tax rate for your convertible bonds. Then my total dollars was 960, and here it's 2.88 million. Here my preferred shares, the dividend, I'm going to put the rate here. It's 2.1. And for the common shares, it's a minimum of $3. And they want it, yeah, $3 minimum. But management want plus $1 dividend per common shares for a total of $4 per common shares. It's gonna make more sense, I think, when I calculate it. Okay, so after that, what I'm gonna do, I'm gonna put here my preferred shares and my common shares. And then here I'm gonna calculate the amounts. So the preferred shares, they are accumulated. That means that any dividends that hasn't been paid in previous years, you're gonna have to pay it now first before you're paying any dividends to your common shareholders. They say that the dividends were last declared in 2012. So the last time that the preferred shareholders have been paid is in 2012. So now we're in 2015. So that means that in 2013 and 2014, they haven't been getting their dividends. So we have to pay these first. So the dividend for 2013 was 2.1 times the 36,000. And 2014 is the same thing. For 2015, we're still calculating first your dividend for the preferred shareholders. It's always the first one that you're calculating. So it's the same amount. Then you're calculating your minimum dividend for the common shareholders. I can't spell, so hopefully you guys understand. So the minimum dividend is $3 per share. So what I'm going to do is I'm going to do $3 times the number of common shares. That gives me $3,370 and $500. Then I'm gonna do, so now the minimum dividends have both been paid for the preferred shareholders and the common shareholders. So now it is on, they're both gonna get an amount of dividend based on the same, on their participation. So what I mean here is that this sentence here, so after that they both got paid their minimum dividend, they're participating at the same rate in the rest of the dividend that's been allocated. So what I mean by participating the same rate is that they're going to get the same amount per of dollar, depending on the number of shares that they have. So for the common shareholders, the management wanted them to get a $4 dividend per common share. Here you have the $3, so we're going to add the dividend so it gets to $4. So we're going to add a $1 dividend. So $1 times the number of shares. For the preferred shareholders, they're participating at the same rate as the common shareholders. So they're going to participate to find the amount that they're getting. You're doing $112,500 of the common shareholders divided by the total value, book value of the common shares times your total book value of the preferred shares. So let's find the amount of dividends for the preferred shares. And that gives us $37,500. Yeah, so the $1 is because the management wants that each common share would be entitled to a dividend of $4 per share. We know already that the common shareholders get a minimum dividend of $3 per share. So then how much is missing to get the $4? It's $1. Is that clear? If the $1 wasn't mentioned, well, the thing is that here it has to be mentioned because they're not giving us the amount of dividend that they're paying for the year. So they would have said here that they're not participating in excess. So we would have stopped here. If they still said this sentence, they would have given you the total amount of dividend that was paid. And then what you would have done is that the balance of dividend, after you're subtracting these amounts, you're going to do the amount and divided by the total amount here times their book values for each to find the participation amount for both. No problem. So your total dividends that are going to be paid for both is going to be these amounts. So for your preferred shareholders, they're going to get a $264,000 dividend. Your common shareholders are getting a $450,000 dividend. And then in total, the company is going to declare $714,000 in dividends for the year 2015. And we're finally done with question 1. It's a long one. Hopefully, they're not as long in your exam. Yeah. So the calculation, what I did the amount of $1, so the amount of dollars that the common shareholders are getting for the participation, divided by their book value. So I get the percentage of participation of the common shareholders. And then I do that percentage times the book value of our preferred shares. No problem. All right. So question 2, it's on income taxes. I'm gonna put on some like key theory that you should like definitely know for your exam. So first thing is that under ASPE, you can use either the deferred tax method or the future income tax method. For the future income tax method, there's a difference between, they do a difference between the non-current versus current tax account. So you're putting it as, it depends on the underlying asset that you're calculating your deferred income tax account for. So for example, if it's a warranty that you're calculating a future income tax provision asset, if the warranty is going to get like reverted in the next year, then you put it in a current account. If it's getting reverted in 3 years, then it's going to be non-current. Same thing if it's for your depreciation is linked to a long-term asset because you're taking depreciation. So the total amount is going to go in your non-current. For IFRS, it's the deferred tax method, and it's all non-current. Then for the checks, know when it's a DTA versus DTA. Well, to know whether it's a liability or an asset. If your expenses under ACCO versus what you actually paid under tax. If your expenses are smaller than what you paid, it's a DTL. If your expenses are greater than what you paid, it's a DTA. So it's a liability, it's an asset. For revenues, it's the reverse. So revenues under ACCO versus what you actually collected under tax. If your revenues are greater than what you collected, it's a DTA. If your revenues are smaller than what you collected, it's a DTL. Also, if when you're doing your reconciliation table, if the sum of your temporary differences is positive, then it's going to be a DTA. And if the sum of your temporary differences is negative, then it's a DTL. And then permanent differences are what's not admissible under tax laws, and it's never going to be reversed. It could be off membership fees. The sum of the temporary differences when you're doing your reconciliation, you're going to start with your, I'm going to show you later. But basically, you're starting with your accounting income, then you have your permanent differences. Yeah, no problem. You're going to get it later. So your golf membership could be like the life premium that the company took on the CEO, could be fines and penalties. It could be, I think that's it. Your meal and entertainment expenses, only 50% is admissible under tax. That's all I can think of from the top of my head, but those are the ones that you see the most often in your problems. And then temporary differences, eventually they're going to get reversed. So it's just a timing difference. So that could be your depreciation versus CCA, could be warranties, could be prepaid rent, could be installments, sales, could be a lot of things. And yeah, so I think that's pretty much it for, like, that's the big lines of the chapters. Now applying this in the problems in different game, but we're gonna do this problem together. Hopefully it's gonna help. Oh, and also for the chapter, just in general, know what to do when there's a change of tax rate, know what to do when there's a carry forward and carry backward. You're definitely gonna get questions on that on your exam. So for question 2, BCD Inc. following ASPE reported accounting income before tax of $405,000 for the year ended December 31st, 2016. Additional information related to income taxes is as follows. Depreciation for the year on capital asset was $205,000, and capital cost allowance claim was $194,000. Cash remitted to the pension trustee for the year by BCD was $270,000. Pension expense recorded by BCD was $280,000. For tax purposes, the cash remitted to the trustee are deductible as pension costs. There were no previous timing differences related to the pension plan, and the accrued pension liability at the end of the year is considered non-current. Life insurance premiums of $12,000 on the insurance policy on the life of the chief executive officer of BCD was paid by the company, and which is non-deductible for tax purposes. Warranty cash disbursements equaled the recorded warranty expense in 2016. On January 1st, 2016, the government unexpectedly changed the income tax rate from 30% to 25%, effective immediately. On that date, BCD had a $200 cumulative timing difference related to the warranties, with the amount of warranty expense exceeding the warranty cash disbursement to date. It's expected to reverse in equal amounts in 2017 and 2018. On the December 31st, 2015, the net book value of the capital assets, so accounting basis of BCD, was reported at $800,000, and the amount reported on the December 31st, 2015 tax return for UCC was, that's not the right amount. Corrected, it's supposed to be $730,000. So I switched the 7 to 3. So it's supposed to be 730,000 and not 370. That's going to be a major difference. So please correct it. So the first requirement is to prepare all income tax related journal entries for BCD Inc. for 2016. So I'm going to start with my reconciliation schedule. Always start by that so you can find your taxable income. So my reconciliation, I'm going to start with my accounting income before tax. The amount was $405,000. All right, and then I'm gonna adjust for my permanent differences, which there's only one, and it's the life insurance premium of $12,000. So this is just not acceptable for tax purposes. So what happened is that they deducted it to get to your accounting income before tax. So they put it as an expense, so it reduces it reduced your accounting income. So we're gonna add it back as a positive number to cancel its effects. So my insurance premium, I'm gonna add back the $12,000. And then you get your adjusted income of $417,000. All right, after that, it's our temporary differences. And I'm just gonna go down the lines. So it says here that my depreciation was 205. So under accounting income, my depreciation expense was $205,000. So I want to remove its effects. So I'm gonna add it back. And the CCA is of 194,000. So then I'm gonna remove the depreciation that's allowed under tax. Then it's for the pension. So the cash remitted to the pension trustee for the year was 270,000. They paid that amount cash. So that's what we're gonna put as an expense for tax. But they recorded accounting 280. So my pension expense, ACCO, is 280. So I'm gonna add it back to cancel its effects on my income. And then I'm gonna deduct my pension payments under tax of 270. And then they're talking about warranties, but there's no temporary differences for the years. So see here, the warranty cash disbursements equal the recorded warranty expense in 2016. So there's no temporary differences for 2016. So yay. And that gives us our taxable income. So our taxable income is our adjusted income plus all the temporary differences. So it's $4,038. So what I'm gonna do first, I'm gonna calculate my current tax expense. So my tax rate for 2016 is 25%. So it changed on January 1st, 2016. So for the year, it's 25%. So that's gonna be my tax rate. And that gives me a current tax expense of $109,500. So the transaction for that is, well, we're using ASCII. And just because I don't think I did any problems using the future income tax method in my first tutorial, I'm going to use that for this problem. But you could have used a deferred tax accounts and it would have been fine. So what you're going to put down is your provision for income tax, and it's your current. It's going to be this amount, and then your income tax payable. This amount. Then I'm going to do my transactions for the rate change. So the rate changed from 3% to 25% in 2016. So any income tax accounts that we had, so any liabilities or assets that we had previously, we put them down as 30%. But now we need to adjust them to put them at 25% tax rate because they are for the future and they should reflect your future tax rates. So what I'm going to do, I'm going to first find which expenses have been affected. So which assets and liabilities I calculated previously and how much I wrote them down for, and then how much they should have been. And then that difference between the two amounts is going to come and reduce the balance to get them to 25%. So for example, I know that my warranties had a $200,000 cumulative timing differences on January 1st. What that means is that in the books, you have an asset or liabilities for that $200,000 times 30%, but it should be at 25%. So we know that. 2, is it an asset or a liability? It says that the amount of warranty expense is exceeding the warranty cash disbursements to date. So that means that what you recorded under ACCO is greater than what you actually paid. So if we look back here, when what you recorded is greater than what you paid, it's a deferred tax asset. So provision income tax, no, future income tax account asset. So we're gonna want to reduce your deferred or asset account by 5%. So for the warrant, okay, wait. I'm talking about, I'm gonna put down the numbers for the rate changes. I'm gonna do first the warranties. So what do you have in your books on January 1st, 2016? You have because your expense is greater than what you paid, you have an asset account in your books. The amount of that asset account is 200,000 times 30%. So that's your old tax rate. The amount that we want now that it changed to 25%, we want 200,000 times 25%. So we want 50,000. So that means that we're going to come and reduce your asset by $10,000. Okay, so reduce asset by 10K. Then you're going to have also a rate change for your depreciation versus CCA asset or liability account. Be careful here because what they give us is the book values of under accounting and tax. So it's not the actual amount of expense. Also, something to know for depreciation versus CCA is that normally, well, not normally, I'd say like 95% of the time, when you're first depreciating an asset, you're going to set up a liability account for your income taxes because you're going to be taking more CCA in the first few years. And then as time goes by, your CCA is going to get smaller, but your depreciation expense is going to become bigger than what your CCA. So it's going to come and reverse the amount of liability. So here, the catch is that you have to think about the fact that you set up first a liability account for your depreciation versus CCA. And that liability account, so you just set up a liability account. So your difference between your UCC and your book value is going to be the value that we're going to use to find what they recorded in the books. So we have to look at what's the book value and what's your UCC. The book value is $800,000 and your UCC is $730. I made a mistake here. Switch it because otherwise it's a really big difference. So your difference between the two is 70,000. So that 70,000 is going to get reversed eventually. It's going to become zero as time goes on, as the asset is more depreciated, as the asset is more CCA'd, it's going to become zero. But for now, the difference is 70,000. So you're going to want to reduce your liability account. So what you have in your book, you have a future income tax liability of 70,000 times 30%, so times your old tax rate. What you want in your book is a liability of 70,000 times 25%. So you want to come and reduce your liability account by 3,500. And those are the only two accounts that are affected by the change in tax rate, because your pension expense is the first year. In 2016, it's the first year. There was no previous timing differences, so you don't have to care about that. And then life insurance premiums, permanent differences, you don't have to care about that. So your transaction for the rate change is going to be, you're going to come and reduce your future income tax liability. Why is there no timing? So there's no timing differences for the warranty in 2016. Because in 2016, what you paid is equal to what you expense in your statements. But there was one in 2015 or in 2014 that you set up, yeah, no problem. So you set up previously your tax accounts, but this year there's none. For the transaction, you're reducing your liability by 3,500. And you're decreasing your future income tax asset by the amount that we found for the warranty, which was 10,000. And then the difference between the two is going to come and impact your provision, income tax, future. So that's your in your income statement, and it's going to be 6,500. All right, so I did the transaction for the rate change. We're not done yet. I have to do the transaction for my timing differences for the year. So my transaction for depreciation versus CCA. So here, if we just look at the net of the two, right? You see that it's positive by 11,000. So if you look here, you would say, oh, okay, well, the sum is positive, so it's an asset. But remember that you first set up a liability. So you want to come and reduce your liability instead. I'm sure if you put in an exam that as an asset, it should be fine, because at the end you're canceling each other. Should be fine still, but just keep in mind that you set up first a liability and then you want to come and reduce that liability. So I'm going to come and reduce my liability by 11,000 times 25%. So I'm basically taking the differences between the two times my tax rate. And then that goes into my provision, income tax, future for the same amount. And then for my pension, first year, so we don't care whatever amount we get here. If it's positive, negative, then it's going to be either an asset or liability. So here it gives us a difference of 10,000 positive. So we're going to set up an asset account. It's going to be future income tax asset and provision income tax future of 10,000 times 25%. Am I missing anything? Warranty for 2016, there's no transaction. I did the current tax expense. Should be good. Should be good. We can move on to B. Also, I'm sorry, we're probably going to go over time from what I'm seeing. So, yeah. Okay, so for 2, they're asking us to do the income statement for 2016. So it's net income before taxes, and that was $405,000. Then you're going to have your provision IT current. So that's your income tax for the year. I'm putting it as a negative because it's an expense and we're doing the income statement. Just so I remember that I need to subtract it to my net income. So my current Tax expense is 109,500. And then I have my provision IT for future. And that's going to be, I'm going to sum them all up. So I have one here, which is a debit. I have one here, which is a credit. So it's going to come reduce it. I have one here that's a credit that's going to come and reduce it. So it's 1,250. So my total amount of expense is going to be $110,750. So my net income after tax is going to be 405 minus 110. So $294,000. For 3, what is the balance of the deferred tax account at December 31st, 2016, and how would it be classified between current and non-current? So I want to find the balance for the liabilities and assets that I set up for the warranties, for the depreciation versus CCA, and for the pension. So at the beginning of 2016, for the warranties, I had 200,000 times 30% as an asset. For the depreciation versus CCA, I had 70,000 times 30% as a liability. And for the pension, I had nothing. My 2016 rate change here, it reduced it by my balance by $10,000. Where is it? Yeah, it reduced my asset by $10,000. Yeah, reduce it by $10,000. For my depreciation versus CCA, it reduced my liability by 3,500, and there was no effect on my pension. And then for my temporary differences for 2016, for warranties, there was nothing. For my depreciation versus CCA, it decreased my liability by 2,750. And for my pension, it created an asset of 2,500. Sorry, my cat is like causing trouble right now. Okay. Okay. All right, so my balance at the end of 2016 is 50,000 for warranties as an asset, a liability of 14,750, and an asset of 2,500. So then I want to classify them as current versus non-current. So for my FIT assets, current, the warranties and non-current. The warranties, they said that half of it was payable, was reversed in 2017, and half of it in 2018. So half of it is going to be current and half of it is going to be non-current. This is a liability. And then for pension, it mentioned that here it's all non-current. So I'm going to put it all as non-current. And then for my liability, it's all as non-current because it is with a, it's for the assets. All right, so net, what I'm gonna have an asset because I have more assets than liability. And then I have a current FIT asset of 25,000. And then a non-current FIT asset of 25,000 plus 2,500 minus my non-current liability. So that's how it's going to be showed on the balance sheet for the company. Then for section B, which I think is like your assignment. West Limited began operation on January 1st, 2016. West Limited reported the following amounts and information for 3 years ending December 31st as follows. Then they give us the accounting income, depreciation, CCA, and tax rate. And then assume all changes to future tax rates were enacted on January 1st, 2016. West's management is confident that it is probable the company will be able to use any tax losses carried forward. So first, they want us to prepare all the income tax related journal entries for the 3 years, and then what is the gross amount of the carry forward for 2019. So again, I'm going to start with my reconciliation schedule, but now I'm going to put all 3 years in one. And I'm starting with my accounting income. So my accounting income for 2016 was 550,000. For 2017, it was a loss of 1.4 million. And for 2018, it was $200,000. Then I'm going to reverse my depreciation expense effects. So minus 100,000 for all 3 years. And then for my CCA, it was 170, and 100,000. I'm going like super speedy because I think you should be fine for that. Then that gives me my taxable income of this amount for the 3 years. This is, of course, is that it? Is that correct? I feel like this is not correct. Oh, I need to add it back as a positive to cancel its effect. Same here. And I remove the CCA. All right, that makes more sense. And then the tax rate was 25%, 30%, 30%. And current tax expense. There's none for 2017 because it's a loss. And for 2018, it's this amount. All right. For the transaction. For 2016, I'm first going to do my current tax expense, which is going to be 120,000. And I'm going to have my income tax payable with the same amount. And then I have to look here, is it going to be an asset or a liability? So the difference between the two is negative by 70,000. So it's going to be a deferred tax liability or a future income tax liability account. So I'm just going to put the TL. And that amount is going to be the sum of the difference times future tax rate of 30%. Because we know in 2016 that the future tax rate for the future years is going to be 30%. So we're going to set it up immediately as that amount. Then here we have our deferred tax expense for the same amount. That's it for 2016. For 2017, we have a loss. So what we're going to do first when we have a loss, we have to look at, okay, did I have income? Did I pay income tax in the last 3 years that could apply this loss to? And the answer is yes. In 2016, you paid $120,000 in expense, in current tax expense. So you're going to receive some $120 from the government. I'm sorry if you can hear my cat. She's crazy. And that's going to be a current tax benefit for the same amount. Then you have to think, okay, I applied it all against my previous income tax expense that I paid. In the future, in the next 20 years, do I think that I'm going to be able to use this loss? Do I think I'm going to have income taxes to pay in the future years? Answer for this company is yes. They think that it's probable the company will be able to use any tax losses carry forward. So we're going to carry forward 100% of the balance. To find the balance, what we need to do is we need to take our taxable income, well, loss of $1,470,000 minus the taxable income of the years that we're receiving the taxes that we pay. So in this case, the taxable income of 2016, so minus 480,000. And then, well, let me just check something. If I do this times, okay, that works. Number seemed weird for a little bit. Okay, so I know that my balance, my carry forward balance is $990,000. So I'm going to set up a deferred tax asset and a deferred tax benefit for the $990,000 times the tax rate. And then for 2018, you have no temporary differences because your depreciation in CCA is equal, so yay. But you're going to be paying taxes of $60,000. But you have a carry forward balance. So you're like, okay, well, I can not pay taxes. I can just use my carry forward balance. So because your DTA is going to, well, because you're smaller, your balance is smaller than your taxable income, you can pay no taxes, basically. So you're going to have a deferred tax benefit of $60,000. And that's going to reduce your DTA of the same amount. So your balance for 2019 is going to be your $990,000 minus your taxable income of 2018, which is $200,000. So your balance for 2019 as a carry forward is going to be $790,000. All right, so accounting for pensions. I'm going to skip all the talking here because it's really long for no reason. Basically, here is the balance for 2019. Well, it's the balance for 2018 at the end of the year. It's the balance for 2019 that's going to be available. So here basically the boss is saying that he lost the information on the pension worksheet and there's some information that he remembers. Is there any theory that you should know for this? I think I'm going to go through the theory as I go. So Mr. Camp informs you that the sheet had holes where they ought to have been figures. Since he did not have the time to reconstruct the worksheet, he was happy to hand it over to you. He offers the following additional information from his memory. The discount rate as well as the expected rate of return on plan asset was set at an annual rate of 5%. You were unable to see any figures for the beginning balance of either the defined benefits obligation or the plan assets, as these had been punched out. Other numbers were equally mutilated. Every odd numbered year, the defined benefit obligation arising from the plan's operations were measured. For 2015, he recollected that the actuary revised the DBO. He estimated this would have to be increased by 10% of the actual ending of 2015 balance just before this adjustment. This increase was recommended based upon his estimates of the lower mortality rate of retirees of the plan. The plan assets produced an actual return of 4.5% for 2015. In search of information, you sent out 2 emails, one to the treasurer and the other to the plan administrator, provided some quick response from both. The treasurer was able to send you the following figures. The total actual return on plan assets for 2015 amounted to $29,700. And she confirmed that she had remitted $120,000 towards funding the plan. The plan administrator responded with the following information. The current service cost amounted to $105,000 and past service costs incurred on January 1st amounted to $30,000 for 2015. In addition, he mentioned that $156,000 was paid towards existing retiree claims. He apologized that he did not have any prior year end balances readily on hand, but did remember that the fund was underfunded then by an amount of $175,000. So they're asking you to complete the worksheet and do the journal entries. The worksheet is here. Sorry for the quality. It's like a screenshot of a screenshot, but I did it on Excel. So I'm just going to copy it. Copy it here. Oh, it's not as pretty as my Excel. Yeah, that's fine. So basically, it's the same thing as what's in the exhibit 1. So what you want to look at first is, okay, well, the numbers here, can I fill anything out with the information that's given? You know that for your funding entry here, it was 120,000. So that means that your cash here was 120,000. And you already know that because the treasurer said that she remitted $120,000 towards funding the plan. So you know that they paid cash 120,000 during the year. So you can put down your contribution amount, and that means that it increases your plan assets by the same amount. Okay, that's weird. Okay, whatever. Okay, so this is done. Then here we have another number. We can't really do much with it. All it's telling us is that the sum of my expense and OCI will be equal to that amount. And then I have that my balance at the end of my plan asset is $653,000. Not much else that you can fill up with this information. So I'm going to go back and I'm going to try and see if there's anything I can fill up with the information that was given. So they tell us the discount rate, which is 5%, which for now is not really useful. We can't see the beginning balances. This is going to be for the actuarial loss on DBO. We're gonna have to increase our balance by 10%, but that's only going to be at the end when we have all these numbers. And then the plan assets produce an actual return of 4.5%. So that could be useful in the future. All right, so the treasurer, what did they say? The total actual return on plan assets for 2015 amounted to $29,700. Oh, that I can put it somewhere. That I can put it in my plan asset here as a positive. That's the actual return. And then your expected return minus the difference between the two is going to be equal to your actual return. Also, because they gave us the actual return of 4.5%, we're going to be able to calculate our plan assets balance, because your actual return is your plan assets times your actual return rate. So if we do our net return on assets divided by the rate, we're going to get the plan assets balance. So it's the 29,700 divided by 4.5%. So $660,000. With that, we can also calculate the net return on assets because we have the expected rate. So how you find that, you do the discount rate of 5% times as a negative times the beginning balance of our plan assets, $33,000. And then the difference between $33,000 and $29,700 is going to go in my OCI as a loss. So if I add them together, it should give me my actual return of $29,700, which is the case. So we're good. So we fill up one line. All right. So after that, they tell us that their current service cost is $105,000 for the year. So I'm going to put it there. And that the past service cost was $30,000. And that he mentioned that $156,000 was paid towards existing retired claims. So that goes in my benefits paid and reduce my DBO and my plan assets. All right. Now what? Is there any other? Yeah. It says here that at the beginning of the year, the plan was underfunded by 175,000. So here it's minus 175,000. And when it's underfunded, it means that your DBO is bigger than your plan assets. So your DBO is going to be $660,000 plus your $175,000. Oops, I forgot to put here my negative. All right. So all I'm missing is my interest cost and my actual aerial loss on DBO. So I'm going to be able to calculate it once I find my interest cost. Now, I think, Kathy, you asked me last time, when do I know to put the past service cost or not when calculate the interest cost? And it bugged me for so long. So I have an answer. You add them to calculate your interest cost when it states explicitly, like word for word, that the past service costs were incurred at the beginning of the year. So in this case, on January 1st, 2015, sorry. Hold on, no problem. It was bugging me for so long. So here, it is the case. They say that the past service costs for the year, where was it? Were incurred on January 1st. So I know that in my calculation here, I'm gonna add my past service costs. So it's gonna be my beginning balance of my DBO plus my past service cost times 5%. And here as a negative. And then all I'm missing is my actuarial loss on DBO. And this amount basically is 10% of all my transaction in the DBO for the year, because it was estimated that the DBO balance should be increased by 10% of the actual ending 2015 balance. So that means that it's going to be the sum of all of these, maybe as a negative, we're going to see, times 10%. So 81,000, that's not right. It's not right, that's right. Did I make a mistake here? 105, 30,000. Is there something I'm missing for 122.15? Oh, here it's a negative, not a positive. Okay, yeah, now I got the same amount. So don't forget your DBO is a liability. And I'm gonna put the same amount here. Oh, here it's a positive. And here it's the negative because it increases the DBO by 10%. All right, so now I can find my balances for my expense, for my OCI, and then it's change, huh? Okay, I'm just going to calculate 835,000 plus 30,000 times 105. Okay, makes more sense. Here, yeah. So here, I put it as a negative because they say that it's an increase by 10%. And the DBO is a liability, so it increases when you put it as a liability. And the worksheet is as a debit account, basically. So when you see negative, it's like credit, and when you see positive, it's a debit. So here I put it as a negative because it's going to be a credit to increase my liability of the DBO, and makes sense here because your loss normally are a debit. And then your $120,000 here. Yeah. So I'm going to check here if my expense in OCI is equal to the 234,000 I was giving earlier. And yes. Woohoo. And then here I'm going to calculate if this works. And here too. So I have these two amounts. I'm going to see if my plan asset of 653,700 plus 289,275 is equal to 942,975, and that's the case. So we know that our worksheet is correct. Oh my God, I'm sorry. My cat? Okay, she woke up. Okay, so I'm gonna do my transactions. So I have my pension expense, my OCI, and then my accrued post retirement assets / liability. And then my pension expense amount is 145,000. OCI is 89,000. And then this is the sum of the two, which should be 234,000. And then for the amount that you pay, so your funding entry is 120,000, and credit cash for the same amount. And we're done. And finally, last question for the lease. A little bit of theory for this one. We saw it last week, but just to bring us back in the mood. We're going to see executory costs in this question. It's not included in your PV calculations, your expense. And for this question, since both company, spoiler, are using ASPE, I'm going to just show you the IFRS criteria first, and we're going to see the ASPE criteria while we do the problem. So IFRS criteria is if it's less than 1 year, it's a short-term lease, or if the minimum lease payment is less than 5K, which means that it's immaterial. If one of these is met, it's an operating lease. Everything is expense. So operating lease expense it like rental fees. And for capital lease, you capitalize it like equipment. You can elect to have an operating lease, but it's not really beneficial because you prefer to have assets than expenses, right? So yeah. All right, so we'll jump into the problems. McKinney Company, the lessee, enters into a lease agreement with Freezy Company, the lessor, on July 1st, 2008 for equipment. Both companies have December 31st year ends. The following data are relevant to the lease agreement. The term of the non-cancellable lease is 4 years with no renewal option. The equipment reverts to Freezy, the lessor, at the termination of the lease. No residual value is expected then. Payments of $126,807 are due on June 30th of each year. The fair value of the equipment on July 1st, 2008 is $420,000. The equipment has an economic life of 6 years with no salvage value. McKinney amortizes similar machinery of its own it owns on a straight line basis. The lessee directly pays all additional executory costs, which are $4,000 per annum, incurred evenly throughout each year. McKinney incremental borrowing rate is 10% per year. The lessee uses ASPE is aware that the lessor used an implicit rate of 8% in calculating the lease payments. So, indicate the type of lease McKinney Company has entered into. Similarly, indicate the relevant classification for Freezy. Support your conclusion by applying the appropriate criteria under ASPE. So A, I'm going to do first for McKinney, the lessee. So the 3 criteria for ASPE to know if it's a capital lease is, do you have a bargain purchase option at the end of the lease, or do you keep ownership? For them, there was no mention of any of that, so I'm going to put no. 2 is the lease term more than 75% of the useful life? So here the lease term is 4 years, and the useful life of the asset is 6 years. So no, it's not met. And then 3, the last one is if is the present value of the minimum lease payment at least 90% of the fair value of the asset. So we're going to calculate it. Your N is your lease term. Your I, under ASPE, you take the lower rate. So in this case, we're going to take 8% for the lessee. So here, the lessee and the lessor have different rates. They have 10% or 8%. So under ASPE, the lessee is going to take either 10% or 8%. In this case, you're going to take the lesser rate, which is 8%. Under IFRS, if the lessee knows the lessor's rate, they take it. And if not, they their own rate. So if here we were looking for IFRS instead, well, we would have used the 8% still because they knew that the lessor used 8%. So here my rate is going to be 8%. My payment is $126,807 per year. My future value, there's no BPO or guaranteed residual value. I'm going to put 0. I made just a little clarification about the unguaranteed residual value. I think I said in my tutorial that you put it there as a future value if you have it. You put it there if you're the lessor. If you're the lessee, you're gonna still put 0 because they're not gonna take it at the end of the lease. So lessor, you put the unguaranteed value as future value. For the lessee, you put 0. And then we can find our present value, which is going to be 8, number of periods 4, payment is this, 0, end of period. So we can say $420,000. So is it at least 90% of the fair value of the asset? Well, the fair value of the asset is the same amount. So yeah, it works. For freezing, so it works. So yes, this one is complete. So since you need only one of the 3 criteria for it to be a capital lease. For freezing, the lessor, we're going to use the same thing here to calculate it. So first criteria doesn't change, lease term doesn't change. Here, does it change? No, the rate is still 8% because the lessor uses 8%. So here is still 8%, and there's no unguaranteed residual value. So criteria 3 is met. It's going to be a capital lease for the lessor. There's 2 additional criteria for the lessor. One, can they reasonably estimate their payment? Well, predictable, sorry. Can they predict that they're going to receive the payments from the lessee? And 2, do they know their future costs linked with the lease? There's no mention of it in this problem, so I'm going to assume that they're fine. So I'm still going to use a capital lease. And then for the lessor, you want to see, is it a sales type or a direct financing capital lease? So for the sales type, it's if the book value of the asset is smaller than the fair market value. And there's no mention of what the book value is. So I'm going to assume it's a direct financing capital lease. All right, so 2, prepare the lease related journal entries on the accounting books of the lessee and the lessor for July 1st, December 31st, and June 30th. So I'm going to do first for the lessee. I'm going to do July 1st, 2008. So on July 1st, 2008, they entered into the lease agreement. So the lessee, they gain an asset. So they gain the equipment under the lease. I think it was equipment. And they now have the obligation. The amount that you're putting here is your present value of the minimum lease payment. And that's it for July 1st. For December 31st, 2008, what's going to happen? December 31st, the lessee has to take depreciation on the asset. Depreciation is going to be your book value divided by the lease term times 6 months out of 12, because it's July 1st. So it's 6 months in the year and not the full year. For the amount of time to use when depreciating for the lessee, you're going to use the lease term when they don't get the asset at the end of the lease. You're going to use the useful life of the asset when they keep the asset at the end of the lease. Okay, so your accumulated depreciation is the same amount. And then you're also gonna have your interest expense for the 6 months, but you're not paying it now. You're only gonna pay it on June 30th, 2009. So the payments are due on June 30th. So you're only gonna record the 6 months interest. That's for your depreciation, like the number of years that you're depreciating. For your N. No problem. So here what I'm going to do a little schedule. So I'm going to put my dates, payment, interest, which is 8%, difference, and balance. On July 1st, 2008, my balance is 420,000. I'm going to calculate for June 30th, 2009, June 30th, 2010, June 30th, 2011, June 30th, 2012. So for the 4 years, my payment each time is my minimum lease payment of 126,000. My interest is 8% of the previous balance. My difference is my payment minus my interest, and that difference is going to come and reduce my balance. All right, so, and we're at 0 balance at the end. So that's great. Always a good sign. So my interest expense for December 31st, 2008 is going to be 50% of the interest that I'm going to pay on June 30th, 2009. So only for the 6 months, for 6 months of the lease term. Then you're also going to recognize the executory costs, and that can be cash or accounts payable. They don't really mention if they pay it each month. But for the year, it's $4,000. So for 6 months, it's going to be $2,000. And that's it for December 31st. Then they ask us for June 30th, 2009. So they're going to have the interest payable, they're going to have the interest expense, going to have the obligation under lease, and they're going to have the cash. So cash is your minimum lease payment. Your obligation under lease is the difference between your interest and your payment. Okay, hold on. I'm coming by. Okay, it's fine. I scared my cat. I got the 16,800 by taking my interest, I'm going to pay at the end of the first year. So on June 30th, 2009, divided by 2, because on December 31st, you only have 6 months of interest accrued. And then you're going to see here, we're going to have the full interest amount. So here, my interest payable is whatever amount I put on December 31st. My interest expense is the other half of my 33,600. And my obligation is the 93,000. And then I guess your executory costs again. And then if you put it at accounts payable, and then cash. All right, so that's it for the lessee. Now for the lessor. On July 1st, 2008. So what did they record? They recorded a lease receivable. They record unearned interest income, and they got rid of their asset. The asset amount is the same. So I'm not going to be calculating another schedule here. It's going to be the same because they both use the same interest rate. Let's say that instead the lessee used 10%, the lessor would have still used the 8%. So you would have had 2 different amortization schedule for the lease. But it's not the case for them, so I can just use this amortization schedule for both. So my asset that I'm getting rid of is my balance on July 1st, 2008. My lease receivable is my minimum lease payment times the lease term. And then my unearned interest income is the difference between the 2. So that's all they record for July 1st, 2008. For December 31st, 2008, they're gonna record their interest income for the 6 months. So it's going to be 50% of the 33,600. And I guess you can also record the executory costs that they're receiving for the payment. Basically, maybe they're receiving cash. That's going to reduce their executory costs by 2,000. And then on June 30th, 2009, they're going to receive their cash for the minimum lease payment of $126,807, and that's going to reduce their lease receivable by the same amount. They're going to accrue their interest income for the other 6 months. So it's the same amount as what they did on December 31st. And then I guess, again, your executory costs. And cash. Oh, switch that up. Cash. Executory. All right. And then requirement 3. Show how the lease would appear on Freezy, the lessor's December 31st, 2008 balance sheet with the appropriate classification. So Freezy, our balance sheet. For their assets, they have a lease receivable of $507,000, and they have a liability of unearned interest income of $37,000 minus what we accrued on December 31st. So of 70,427. And we're done. That was a long session. I'm gonna stop the recording.